Hello everyone, this is part 2 of my top stock picks for 2026. In the first video, I covered 10 stocks, and since that video was getting a bit long, I decided to break this into multiple parts so we can actually go deeper into each company without rushing. In this video, I'll be covering another 10 stocks that are, in my view, are must buys for 2026. Just like before, I'll walk you through the business model, the balance sheet, my price projections using my valuation model, and the technical setup so you can understand why I believe these companies are positioned extremely well both fundamentally and technically. So with that context out of the way, let's get into the first stock in the list, which is Netflix, ticker symbol NFLX. Netflix is a global entertainment company that offers a subscription-based streaming service. You get access to movies, TV shows, documentaries, and a massive library of original content. And over time, Netflix hasn't just stayed a streaming company, they have expanded into live events and even gaming, which adds more engagement into their ecosystem. Netflix makes most of its money from monthly subscriptions, but what's really interesting is their advertising business have more than doubled in 2025. That gives them an additional revenue lever without needing to aggressively raise subscription prices. Right now, Netflix has a market cap of about $408.5 billion and revenue is growing at 15.4%. Geographically, the US and Canada are still the biggest contributors of their revenue. And in the most recent quarter, they generated $5.1 billion from the US and Canada, $3.7 billion from Europe, the Middle East and Africa, and about $1.4 billion each from Latin America and Asia Pacific. On the subscriber side, they have 101 million subscribers from Europe, the Middle East and Africa, 89.6 million subscribers from the US and Canada. So this is truly a global business with diversification across regions. Now let me show you their balance sheet, because this is where Netflix has really surprised a lot of investors in the last few years. They currently have $9.22 billion in cash, $9.32 billion in cash equivalents, and $14.46 billion in total debt. When you net that out, Netflix actually has negative net debt of about $4.1 billion. In simple terms, if they decided to pay off all their debt today, they'd still have around $4 billion in cash left to reinvest back into their business. On top of that, they are generating $8.96 billion in free cash flow, which is extremely strong. Now let me explain how this ties into my valuation model. Based on current EPS, expected growth and valuation multiples, my model shows 24% upside in 1 year and 190% upside over next 5 years. That would put the stock price close to $260 over the long term. But valuations alone aren't the main reason Netflix made it into my 2026 top picks. The technical setup is also extremely interesting right now. On the daily chart, Netflix is trading below all major EMAs. On the weekly chart, it's below the 50-day EMA and approaching the 200-day EMA. And the RSI is moving towards oversold levels. What's more important is that in the last 10 years, this exact setup has happened only twice, and both times turned out to be a generational buying opportunity for Netflix. That's not something I ignore. Because of all this, I personally started building a position. I currently hold 40 shares of Netflix at an average price of $98, and I plan to buy more aggressively during this phase, especially if the stock stays under pressure and comes down to $82, which I see it as the next major support level. When I look at Netflix right now, the balance sheet, the cash flow, my valuation model, and the technical setup, everything is lining up. This is definitely a stock worth studying closely if you are thinking long term. Let me know what you think about Netflix at these levels and whether you are planning to buy or already have a position in it. Alright, with that said, let's move on to the next stock on the list, which is ServiceNow. This is a company that helps large organizations run better internally. ServiceNow provides a cloud-based platform that automates and digitizes complex business workflows. Instead of using a bunch of disconnected tools, everything runs through one centralized system. And now with AI-powered agents layered on top, productivity goes to a completely different level. From a business model perspective, this is exactly what I like to see. ServiceNow makes money primarily through subscription-based SaaS revenue. Companies pay annual fees to access their platform, which means recurring revenue, predictable cash flows, and continuous updates baked into the model. They also have very sticky customers. Alright, now let's look at their numbers. ServiceNow currently has a market cap of about $147.9 billion and revenue is growing at 21%, which is extremely strong. And if you pull up their quarterly revenue chart over the last 10 years, it's honestly close to perfection. Very few companies in the world execute at this level quarter after quarter. In the last quarter, they reported $3.3 billion in revenue from subscriptions and $108 million from professional services. And let me show you their balance sheet, because this is where the confidence really builds in. ServiceNow has $2.73 billion in cash, another $2.72 billion in cash equivalents, and total debt of about $2.4 billion. That puts their net debt at negative $3.1 billion, meaning they could pay off all their debt today and still have billions left over. On top of that, they generate about $3.9 billion in free cash flow every single year, and that number is expected to grow as their AI products scale. From a valuation standpoint, using my model, I'm seeing about 24% upside over the next 1 year and roughly 199% upside over the next 5 years. Now let's also bring in their technicals. Technically, ServiceNow is trading below its 200-day EMA on both the daily charts and the weekly charts, which already puts it in a strong long-term accumulation zone. On top of that, the weekly RSI is approaching oversold levels, and historically, whenever ServiceNow gets into this zone, it doesn't stay there for long. A bounce usually follows. Because of this setup, I've been actively selling cash secured puts, and just last Friday, I got actually assigned 100 shares at $146, and I'm completely fine owning this stock at this level. From here, I'll be closely watching their next earnings report to see how the growth trajectory looks, especially around AI-driven demand. So overall, ServiceNow is really in an attractive zone, and a turnaround is most likely to happen soon. Alright, next up on the list is Duolingo. Duolingo is a language learning company that operates its website and mobile app primarily in the US and China. The platform currently offers courses in 40 different languages, and the bigger picture here is that Duolingo is trying to revolutionize education using AI. Today, the platform has over 50 million daily active users, which is a massive engagement number for an education-focused product. From a growth standpoint, the company is projecting nearly $1.2 billion in bookings this year, representing 33% growth, along with a 29% adjusted EBITDA margin. Importantly, Duolingo is intentionally prioritizing user growth over aggressive monetization, betting on the long-term payoff of AI-powered learning rather than short-term profits. And because of that strategy, the stock got punished. Duolingo is now down over 50% from last year highs, even though the business fundamentals remain strong. The company currently has a market cap of about $7.48 billion, and revenue is growing at an impressive 39.86%. In the most recent quarter alone, Duolingo generated $230 million in subscription revenue, and the platform now has 135 million monthly active users and 50.5 million daily active users, which continues to trend higher. Now, let me show you their balance sheet, because this is where things really stand out. Duolingo has about $1 billion in cash, another $1 billion in cash equivalents, and total debt of just $93.2 million. That puts their net debt at negative $1.9 billion, meaning they are sitting on a very strong cash position. And on top of that, the company is already generating positive free cash flow of $347.5 million, which I really like at this stage of growth. In my view, many of the fears from Wall Street currently has around Duolingo are overblown. I don't believe ChatGPT or any other large language models can take away Duolingo's core business. Instead, AI enhances Duolingo's value proposition rather than replacing it. Because of this disconnect between sentiment and fundamentals, I see current levels as a solid long-term buying opportunity. Using my valuation model and being very conservative, I'm assuming just 20% annual EPS growth rate. Even with that conservative assumption, I'm seeing about 20% upside over the next 1 year and roughly 149% upside over the next 5 years. And honestly, that's the cautious scenario. On the aggressive side, I wouldn't be surprised if this eventually becomes a $1,000 stock. From a technical perspective, the stock has been heavily beaten down and is now trading below its 200-day EMA on both the daily and weekly charts, which historically has provided strong long-term entry points for high-quality growth names. Personally, I currently own 35 shares at an average price of $265, and I plan to add more to bring that average down during this phase. Overall, strong user growth, a fortress balance sheet, positive free cash flow, and an attractive technical setup make Duolingo a compelling 2026 long-term play, in my view. Alright, moving on to the fourth stock on my list is Palo Alto Networks, ticker symbol PANW. Palo Alto Networks is a leading cybersecurity company that offers a platform-based security model designed to protect enterprises from constantly evolving cyber threats, including AI-driven attacks. As cyber risks continue to rise, especially with AI adoption, companies like Palo Alto are becoming more critical infrastructure than optional software. The company currently has a market cap of about $131.7 billion and revenue is growing at a solid 15.3%. Most of Palo Alto's revenue now comes from subscriptions, which provides strong recurring income followed by product sales. Product revenue did take a hit last quarter, declining from $574 million to $434 million. But this shift is largely due to the company focusing more on platform consolidation and long-term subscription growth rather than one-time hardware sales. Palo Alto Networks has also been very active on the acquisition front, using its strong financial position to expand its AI-driven security capabilities and visibility across enterprise systems. And this is exactly where the balance sheet becomes a major advantage. Looking at their balance sheet, Palo Alto has a total cash position of $3.07 billion, cash equivalents of $3.06 billion, and a total debt of just $346 million. This brings their net debt to negative $5.6 billion. On top of that, the company is generating very healthy $3.69 billion in free cash flow. In my view, this is an excellent balance sheet to have. These are the kinds of financials that allow a company to weather any market volatility, to invest aggressively in innovation and continue acquiring strategically even during downturns. That's one of the main reasons I consistently look for businesses with strong balance sheets. Based on my valuation model, I'm seeing about 21% upside over the next 1 year and roughly 152% upside over the next 5 years, which would take the stock price around $475. And from a technical standpoint, the stock is currently trading below its 200-day EMA on the daily chart and below the 50-day EMA on the weekly chart. Historically, this has not been a bad area to start building a position in high-quality cybersecurity names. That said, if you are looking for a bit more margin of safety, I would personally wait for a pullback closer to $166 range. So overall, strong recurring revenue, heavy free cash flow generation, AI-focused acquisitions, and a fortress balance sheet make Palo Alto Networks a compelling long-term cybersecurity play for 2026. Alright, moving on to the fifth stock on my list is Meta Platforms. Meta is going all in on AI with a long-term vision centered around building personal superintelligence. The company is investing aggressively through Meta Superintelligence Labs, assembling elite AI talent, scaling compute infrastructure, and accelerating next-generation model development. AI is already improving Meta's core business, especially advertising, content recommendations, and business messaging. And it's also powering new hardwares like smart glasses and AI-driven consumer products. Meta is progressing towards Llama 4.1 and 4.2 while also laying the groundwork for future models. On the infrastructure side, they are building Hyperion, which is designed to scale up to 5 gigawatts of compute capacity over the coming years. This shows how serious they are about long-term AI dominance. From a numbers perspective, Meta has a market cap of $1.65 trillion and revenue is growing at 21.2% year over year. Advertising remains their core revenue engine, generating $50.1 billion in the most recent quarter alone. Looking at their balance sheet, Meta has $12.4 billion in cash, $44.4 billion in cash equivalents, and $51.1 billion in debt, which puts the net debt around negative $5.8 billion. This is lower net cash compared to some other big tech names like Google, Amazon, Microsoft, or Nvidia. That's because Meta is reinvesting extremely aggressively into AI and infrastructure. Despite that, free cash flow remains very strong at $44.8 billion annually, which gives them enormous flexibility. Using my valuation model, I see 17% upside over the next 1 year and about 115% upside over 5 years, which would put Meta around $1,400 per share in the long term. From a technical standpoint, Meta is trading below its 200-day EMA on the daily chart and below the 50-day EMA on the weekly chart. That makes this a reasonable zone to start a position and gradually dollar cost average rather than chasing strength. Alright, the sixth stock on the list is ON Holdings. ON Holdings focuses on performance sportswear, footwear, and apparel, best known for its running shoes like the Cloud and Cloud Surfer. They generate revenue through wholesale and direct-to-consumer channels, including e-commerce and physical retail stores. The biggest revenue by far is their footwear. The company currently has a market cap of $16.3 billion and revenue is growing at an impressive 33.2%. Last quarter alone, shoes brought in $731 million, while apparel contributed to $50.1 million. And from a geographic standpoint, the Americas lead the revenue, generating $436 million. And I've personally noticed a lot of people wearing their shoes. As an investor, seeing real-world adoption gives me extra confidence in their brand momentum. Now, let's look at their balance sheet. ON Holdings has $1 billion in cash, $961.8 million in cash equivalents, and $503.9 million in total debt, which brings their net debt to negative $1.5 billion. They are also generating positive free cash flow of $345.4 million, which is solid. And using my valuation model, I see about 23% upside in 1 year and 187% upside over the 5 years, which would take the stock close to $140. Technically, it's not in the most attractive zone at the moment. If the stock comes down closer to $40, which would align the 200-day EMA on the weekly chart, that would be a near perfect long-term entry in my view. So this is definitely one to keep on your watch list. Alright, let's move on to stock number 7, and this one is very interesting business that often flies under the radar, and that's Copart. Copart operates an online auction platform for the resale and remarketing of vehicles. Their customers are insurance companies, banks, finance companies, charities, and fleet operators. Basically, anytime a vehicle needs to be sold, no matter the condition, it can be damaged, totaled, repossessed, Copart steps in and connects sellers with the massive global buyer base through online auctions. It is a simple model but extremely efficient. It has a market cap of $38.64 billion and revenue is growing at 6.69%. Growth here isn't explosive, but this is a mature, very consistent business. Most of their revenue comes from their services followed by vehicle sales, which makes the business more stable compared to pure inventory heavy models. Now, here's the real reason I'm willing to invest in Copart, the balance sheet and the technicals. Copart has $5.22 billion in total cash, $5.23 billion in cash equivalents, and total debt of just $99.9 million. That debt number is basically nothing compared to how much cash they are sitting on. When we add these up, their net debt comes out to negative $10.4 billion, and on top of that, they are generating about $1.41 billion in free cash flow. That is an extremely strong financial position. This is the kind of balance sheet that allows a company to survive any economic slowdown, any market turbulence, and still keep compounding over time. Now let me show you their valuation. Based on my valuation model, I'm seeing about 15% upside in 1 year and roughly 101% upside over the next 5 years, which would put the stock price close to $80 in the long run. And finally, technical setup. This is where things get even more interesting. Technically, Copart is trading below all major EMAs on both the daily and weekly charts. And on top of that, I'm seeing a reversal forming on the weekly RSI. So even if you are not thinking long term and just want a swing trade, this setup actually looks very attractive from a technical perspective. So when you put it all together, a business model, massive cash position, consistent free cash flow, reasonable valuations upside, and improving technicals, Copart definitely is one worth studying closely. Right. Moving on to the stock number 8 is Airbnb. Airbnb operates a marketplace platform that connects hosts and guests globally. Hosts list the stays and experiences and guests book them through their app or website. The platform mainly offers private rooms, primary homes and vacation homes, which is what made Airbnb such a dominant name in travel to begin with. But here's the thing. Airbnb isn't just a home rental company anymore. They're actively expanding beyond traditional rentals by rolling out service-based experiences. They are piloting hotel offerings and they have launched Reserve Now, Pay Later in the US to drive more bookings. They have also improved their map feature and updated their cancellation policies, which directly improves the user experience. Because all of this ties to their international expansion, which is a multi-year growth strategy. Airbnb is seeing strong growth in international markets like Japan and India, and there's still massive runway outside the US. Alright, now let's look at their numbers. Airbnb has a market cap of about $83.99 billion and revenue is growing at 10.18%, and they have $14.4 billion in total cash, $11.68 billion in cash equivalents, and debt of just $2.27 billion. When we add these up, Airbnb ends up with net debt of negative $23.8 billion. That's an enormous cash position. On top of that, they generate about $4.58 billion in free cash flow. And based on my valuation model, I see about 14% upside in 1 year and roughly 90% upside over the next 5 years. And I'm being very conservative here. And I'm confident that Airbnb can double over the next 5 years from these levels. Technically, I would prefer to buy in Airbnb below $120. That's where I see a much better risk reward setup. So instead of rushing in, my plan is to start selling cash secured puts around $120 level and generate passive income while waiting to get assigned. So when you put it all together, strong global brand, expanding business model, massive cash reserves, and solid free cash flow, Airbnb remains one of my highest conviction long-term ideas for 2026. Definitely a stock worth keeping on your watch list. All right, moving on to the stock number 9 is Block Inc. Block operates through two main ecosystems. First is Square, which provides software, hardware, and financial services to sellers. Second is Cash App, which most of us already know. It allows individuals to send, spend, and invest money directly from their phones. Block's entire strategy is about connecting these two ecosystems. Square brings in the sellers and Cash App brings in the customers. And when you link these two together, you get a very powerful flywheel. Block generates revenue through transaction-based fees, subscriptions, and services. So this isn't a one-line revenue model. Block has a market cap of $42.34 billion and revenue growth is just 0.47%. And don't be surprised by that. Let me tell you why this stock still made to my list. In the last quarter alone, Cash App generated $4 billion in revenue, while Square brought in $2 billion. The business is in a transition phase right now. Let's also look at their balance sheet. Block has $13.96 billion in total cash, $13.58 billion in cash equivalent, and $8.1 billion in debt. That puts their net debt at negative $19.4 billion, which is extremely strong. They are also generating about $1.83 billion in free cash flow. And based on my model, I see 61% upside in 1 year and roughly 346% upside over 5 years, which would put the stock price above $300. That said, to be realistic, this is a long shot, so I would not go all in on this. I would just put a small position, probably 1 to 2% of my portfolio to start with. And technically, the stock is below 200-day EMA on both the daily and weekly charts, so it's not a bad entry right now. But if you ever see the stock price go below $50, that would give you a much better margin of safety. So overall, strong ecosystem, massive user base, improving monetization, excellent balance sheet, and asymmetric upside. With that, Block is definitely one to watch closely for 2026. And the final stock on my list is ARM Holdings. ARM specializes in designing semiconductor intellectual property, not manufacturing chips themselves. Their IP includes CPUs, GPUs, and NPUs, which are then licensed to partners who build their own system on chips. And this is important because ARM's technology is known for power efficiency, which is why it's everywhere, like smartphones, laptops, automotive, edge devices, and now increasingly data centers and AI workloads. ARM generates revenue through two main streams, licensing and royalties. Licensing revenue comes from companies paying upfront to use ARM's design, and royalties are earned every time a chip ships that includes ARM's architecture. So as chip volume grows, royalties scale beautifully. Right now, ARM has a market cap of $117.9 billion and revenue is growing at a strong 24.8%. In the most recent quarter, they reported $620 million in royalty revenue and $515 million from licenses, which shows both sides of the business are performing well. There's one risk I do want to call out clearly, which is competition. The semiconductor space is extremely competitive. ARM faces pressure from established players like Intel and AMD and also emerging architectures. Increased competition could eventually lead to pricing pressure or market share shifts. Because of this, I'll be closely watching every single earnings call, especially management's tone around competition and long-term market share. That said, when you look at their balance sheet, it gives me confidence. ARM has $2.5 billion in cash, $2.5 billion in cash equivalents, and total debt of just $429 million. That puts their net debt at negative $4.6 billion. On top of that, they are generating positive free cash flow of $1.13 billion. Based on my valuation model, I'm seeing about 19% upside over the next 1 year and 138% upside over the next 5 years, which would put the stock above $260. Technically, the stock is trading below its 200-day EMA on the daily chart and bouncing right off the 200-day EMA on the weekly chart. For me, this combination of strong fundamentals, strong balance sheet, supportive technicals makes ARM attractive at these levels. And that wraps up part 2 of my top stocks for 2026. You'll notice I did not include hyperscalers like Amazon, Microsoft, Google, Nvidia, or other top names like Mercado Libre, AMD in this list. Some of them are trading near all-time highs, and I'd like to see a bit of consolidation before discussing about those companies. I'll be doing individual deep dive videos on those names as earnings approach. Let me know your thoughts in the comments below. Which of these stocks do you already own and which ones are on your watch list for 2026? If you haven't watched my part 1 video yet, I'll link it in the description below, so make sure to check it out. Don't forget to like and subscribe. Thanks for watching, and I'll see you in the next one.